Hi, I'm Michael Bernier with Canter Wealth, and today we wanted to provide a summary of what happened in the markets in 2018. We'll start general and then we'll dig a lot deeper into some of the specific numbers. 2018 was a very volatile year. Not necessarily abnormal, but I think coming from 2017, which was a little more abnormal in terms of volatility. Very little volatility in 2017. So I feel like a lot of the volatility in 2018 surprised us as investors. January was actually just an extension on 2017, where both US markets were up, international markets were up, but then in February, markets had gone down. Both US and international markets were down in February. The world stock market was down around 4.5% in the month of February. And then from there, international stocks actually stayed down the rest of the year. And the US market went back up. Throughout the year, it had provided positive returns until the end of September, where a lot of the most recent volatility had started. But if we look at a lot of the events throughout the year, a lot of things had happened. A lot of good news, a lot of bad news. Earlier in the year is where the US started imposing tariffs, and the fear of a trade war surged. In 2018, towards the beginning of the year, we saw the yield on the 10-year Treasury reach 3%. That was the first time we had seen that in years. And then in May, inflation actually hit its highest point that it's been in the last 6 years. Then later in the year, we continued to see the Fed raise interest rates and signaling that that would continue to happen at least over the next year, which provided a lot of uncertainty along with midterm elections. And the one thing the market does not like is uncertainty, and there was quite a bit in 2018. At the same time, there was a lot of positive things that continued to happen in 2018. US profits continued to soar. If we looked at unemployment, it was at its lowest level since 1969. Now let's dig a little deeper and look at fourth quarter specifically in 2018. In terms of US stock market returns as a whole, in the fourth quarter, the US market was down over 14%. International developed markets were down almost another 13% in the fourth quarter, and emerging markets, which were hit hard most of the year, were down an additional 7.5%. If we look at global real estate, that was down over 5% in the fourth quarter of 2018. Now, there were some positive returns in the fourth quarter of 2018, and those came from both the US bond market as well as the global bond market. Nothing to write home about, but those returns were up over 1.5% for the fourth quarter. Now let's look at the entire year. Well, the US market, although it had been going strong for most of the year, ended the year down over 5%. If we look at international developed markets, those were down over 14% for the year. Emerging markets also down over 14.5%. And global real estate was down close to 6% for 2018. For the entire year in 2018, bond returns were positive. US bond returns were nominal, barely eking into positive territory, although global bond markets were up a few percent for 2018. But now, when we really start talking about a prudent investment strategy, you have no idea what's going to happen on a year-by-year basis, and good or bad, you can't alter your investment strategy based on 1 year. So let's take a step back even further and look at the 10-year returns. Now, these 10-year returns are going to factor in 2008, 2009, the Great Recession. US markets over the last 10 years are up about 13%. If we look at international developed markets, on average, they're up about 6% per year. Emerging markets are up around 8% per year, and global real estate, positive 10% per year over the last decade. Also in the bond market, over the last 10 years, the US bond market provided about 3.5% return over that 10-year period on average per year. And if we look at the global bond market, it was up close to 4% per year over that decade. And if we look back at the fourth quarter of 2018, there was really no place to hide. All equity markets were negative. Although bond markets were positive in the fourth quarter, there continues to be concern over rising interest rates. If we then break it down by asset class, large cap value ended up being the best performer, but was down over 11.5% for the year. The worst performing asset class in the US was small growth, down over 20%. Now, if we look at international developed markets, value was the top performing asset class, where small cap stocks were the worst performing asset class. And again, in the fourth quarter of 2018, emerging markets continued to go down quite a bit. Again, value was the best performing asset class within emerging markets, where growth ended up being the worst performing asset class. Now, what's interesting is emerging markets were down quite a bit for 2018, although emerging markets were the best performing asset class in 2017, just the year before. I think that really shows the importance of diversification. It's so easy to try to buy what had done really well the year before. We all want to buy what's performing very well. But at the same time, there's absolutely no way to predict how that's going to work moving forward. For several years before 2017, emerging markets was not a very well-performing asset class, so a lot of people gave up on it. Then you get a year like 2017, where returns were over 30%. I feel like a lot of people then look at that and say, okay, well maybe now's the time to get into emerging markets. It's been a lower performing asset class for so long. The US has continued to do really well. So I see large returns, let me buy more of that. Well, then you get a year like 2018, and a lot of those returns were then given back, and really puts a lot of people questioning their investment strategy. And when we try to time markets, most of the time we fail. And there's so many different examples of that. It's just not emerging markets between 2017 and 2018. If you look back, what this chart is showing is the top row is the best performing asset class for a given year. The bottom row is the worst performing asset class. Even without looking at the specific year and going year by year, you can see that there's no clear pattern. A lot of times the worst performing asset class the year before ends up being the best performing asset class the following year. I think another good example is in 2014, 2015, global natural resources, one of the worst performing asset classes. 2016, it was one of the best performing asset classes. Real estate is a very volatile asset class. If you look at this chart, it would be very easy, if we had this chart ahead of time, to just continue to buy what's doing well and what we knew was going to do well the following year. The problem is we don't have this chart ahead of time. We only have it looking backwards. But unfortunately, that's the way a lot of people make their investment decisions, is based on what's done really well the year before. But hopefully this is a good example and a good chart that illustrates the fact that there's absolutely no influence on what an asset class had done the year before and how it's going to perform the following year or the years moving forward. Now, what we've been talking about thus far is just specific asset classes and specific regions and the value of diversification. But a well-diversified portfolio shouldn't even just focus on US markets and international markets in a silo. You really need to look at how a portfolio comes together and what the returns for a well-diversified portfolio have been over the last 1, 3, 5, 10 years. Here's a good example of how risk and return plays out over an investor's lifetime. On a 100% stock portfolio over the last decade, returned an average of about 10% per year. A 50% stock portfolio with some safety in bonds produced about 5% per year. So although we don't know what the future is going to hold, we have gone through a significant amount of volatility in the recent past. And a lot of times that concerns people and does make them second guess their investment strategy. But a portfolio, and a well-diversified portfolio, needs to be set up for the good times and the bad times. I believe if we have a plan in place and a portfolio is set up for those good times and bad times, then we can feel confident in our investment strategy and not just focus on what's going to happen in 2019. 2019 could shape up to be a much better year than 2018, and there's several people that believe that's the case. But it could also be the start to our next big recession. We are now in the longest bull market that we've ever had, and so eventually the stock market is going to go down. There are still a lot of positives in the market, and it could continue to grow, but I think it's a very good time to reassess your portfolio and make sure that it is set up and aligned with your goals, regardless of what happens in the market in the short term, that you'll be able to get through those time periods, capture any return you can if it ends up being a great year, but at the same time focus on preserving capital and allowing for less downside if the market does go down. As I said, I think now is such a key time for everyone to reassess their portfolios and make sure that it is aligned with their goals and prepared for good and bad markets. If you would like to sit down with us, then please feel free to contact Canter Wealth, and we'd be happy to help.